Welcome. First of all, a little bit of an apology. I was interviewed a couple of years ago and I agreed to do this video then, but I've only just got round to doing it. So big apologies to those of you that have been pressing me. Well, it's only a couple of years, isn't it? I'm doing it now. Okay, so what I'm going to talk about today is how the banks trade. What's their methodology? What to look for on the charts, how you can spot it. It's a little bit harder than it used to be, and it might just be a bit of an eye-opener for you to see why you're being stopped out on trades, or might just help you understand how the markets actually work, because the banks are the ones that move the markets. They move price. Understanding how they trade can help you, and if you can get a chance to ride the back of the bank trades, then you make a lot of money. If you're trading against them, then it's very, very hard, and they are very good at manipulating the market to their own ends. They have to do, it's nothing wrong or secretive or shady. It's just purely the fact they have to manipulate the markets in order to be able to get their big trades on. So another quick apology. I'm not a presenter. I'm not a slick marketer, so it might not be quite as professional, if that's the word, as some of the videos you see on YouTube or webinars or the like. I trade Forex for a living. I have done since 2007, and I just want to share a little bit about what I've learned over those years, and certainly the key elements that have helped me become a consistently profitable trader. So let's have a look at the charts. I've got a Euro US dollar chart up at the minute. It's for a reason. Euro US dollar is by far the biggest traded currency pair in Forex. Most volume goes into trading it by a long, long way. 25% of all trades, even up to 30% at times of all trading volume, is on this currency pair. Retail traders love it. Brokers offer reasonably tight spreads, and so retail traders think they're getting good value for money on it. The fact that it's traded so heavily means the banks are extremely interested in it. There's more liquidity in the Euro US dollar than any other currency pair, therefore the banks will trade it more than any other, and by that very nature, then it is the most manipulated market. So even if you don't take anything else out of this little video, it might be just a question whether Euro US dollar is actually the best currency pair to trade. Other ones are not manipulated quite as much as this. Okay, so this chart here clearly shows, I'll make this up a little bit smaller, clearly shows a wonderful uptrend on the Euro US dollar. This happened in July earlier this year, so it's relatively recent and gives a good example of what banks are looking for. When you've got an uptrend like this, prices moved 650 pips from the 10th of July to the end of July. So in less than 3 weeks, it's moved over 5% of its value, which is quite a big move, to say the least. So it stands to reason that a price up here is a high price. Down here is relatively low. This is a high price. Banks love high and low prices. If they deem a market is high, then they look to sell. If they deem a market is low price, then they will be buying. And like anybody else in that, they look for value. They also look for price levels. Price levels are key. A lot of price levels have a lot of liquidity in them, and that's what banks need to be able to place their huge trades. We're lucky as retail traders. There's nothing to stop us putting our orders into the market at whatever price level we want, and we know we're going to be filled at pretty much damn near that price level. Very, very occasionally will we encounter slippage, and that's only in fast moving markets due to economic news events or the like. So we can put in, even relatively sizable retail traders that are putting 5 standard lot orders in will have absolutely no difficulty whatsoever in getting their order filled at that price level. Banks are different, particularly the big banks. You know, you look at Citi and Barclays and the like. They are putting massive orders into the market, which means that they have to have huge liquidity. So because it's a closed business, it's a closed business model, you have to have, for every selling position, you have to have somebody that buys that position on the other side. So you can't all buy the market at the same time. There isn't the liquidity to do so. So in order for the banks to sell, for instance, there has to be a lot of people that are willing to buy those sell orders off the banks. And if they're putting in huge orders like they are, you need a huge amount of people to buy the sell orders off the banks. That can't be done immediately, and it can't be done at one price level. So the banks have to build positions over a period of time, and that's why it's tricky to see them at times. Tricky to see how they're getting into the market, because particularly with the advent of automated trading now and algorithms, banks have done away with a lot of the human element of trading, and they now use AI and algorithms to trade the markets, which means it's even more difficult to spot, but not impossible. It's just a matter of it takes you time to get used to it. So banks are going to be looking at this and thinking, price is getting high, we are interested in selling. That's all they're looking to do. Never ever will they looking to be buying when a market's going like this, unless it's for a very short period move. So when they want to make the big monies, they want to be selling this market, because retail traders are thinking this thing's going to the moon. All we're interested in is buying. There's a lot of buy liquidity, a lot of buy orders in the market, so therefore banks can soak up those buy orders and put a big sell position on. If we look at this closely, the uptrend has not been broken. There's never been a pullback that has come below a significant pivot low. It's all higher highs, higher lows, higher highs, higher lows, until we get a little higher up and we see a sell-off here. Now this area here has closed, as you can see, well below this significant pivot low. From this high, this is the significant pivot low that would need to be broken if structure is to be broken. So this move down here is clearly broken below this low and closed below it, which is key. So if we trace this back up to where it started from, that area is an area that I am going to be interested in. This price level. It's a zone. Okay. Now I'm going to mark that on with that. I'll put lines either side. I'm going to zoom in. So this is the uptrend that we've just been looking at till we come to the top, where that's the sell-off. And as you say, you can see it's clearly below this level. This is a bank move. You can't move the market in that short space of time more than 200 pips without it being banks involved and big institutions. We don't know why they sold from that level. There's nothing back here at all that would indicate there's a lot of liquidity there, but there obviously was, because they allowed the banks have sold off from there. That doesn't matter. That just gives a footprint. So now we know banks are interested at this level. They look to sell from this level. They deem it as being good value. And so we can use that in the future. As price moves on, as time moves on. The price comes back up to that area. Now if you're a supply and demand trader, this is a clear area of supply. You've had a lovely move up, you've had some consolidation, and then a big move away from the area. Classic supply and demand trading position. All supply and demand traders in the world will be interested in this level if they're trading the euro US dollar. So when price comes back to it, there's every reason to believe that it will sell off from this level. It's done it before, why wouldn't it do it again? And it does. It does sell off. So supply and demand traders are very happy. They're in that sell trade. Just ask yourself where they put their stops. Where would you put your stop? We're all taught to put it in pretty much the same place. All educators, YouTube, videos, trading rooms, gurus, everybody pretty much tells you to put it above or below the recent pivot highs or lows. A few pips away. Sometimes they say quite a lot of pips, but to give it some breathing room, the trade. But we're all told to do pretty much the same thing, and that's what we do. Banks know this. So when supply and demand traders are selling here, they're going to put their stops above here and here. Anybody that's jumped on the back of this down move here that the banks have done will be putting their stops above here. Now what are stops? If you're selling, a stop loss is a buy order to get out of your position. So there's buy orders, there are buy orders above here. Alright. Banks know this. It's starting to get even more interesting for them because we've come up and got a double top now. Price goes back to test that zone. You've got now retest traders involved. So people that trade retests of zones. That is, in their mind, proof that that zone has got validation, validity even, and sells off from that position, comes back up, retests, and will sell off again. So you've got retest traders involved, which again they'll be putting their stops above these levels. So again, adding to the liquidity. Why do we get that? Big spike up. The likelihood is, we don't know for certain, but that's a bank or two just saying, I want to get some of that liquidity that's sat above here. So they quickly, within an hour, move the price up. So they buy into the liquidity area, soak up all that liquidity, not all of it, but they soak up enough liquidity to get their position on, which is a sell position. So all of these buy orders, they'll be selling to those buy orders, and they will take price the other way. So once they've got their huge sell orders in place, they'll dump some more in there to move the price down. And the profit, that's a quick profit. That's 2 hours, in less than 2 hours, they've moved the market up 30 odd pips and down 70 pips. So they moved it up and down. As you can see, they're taking it a little bit further, maybe that might have been them, or it doesn't really matter, but in 2 hours they've moved the market quite dramatically. Now that's not a huge move, don't get me wrong. It might be some of the lesser banks or larger hedge funds or whatever that have done that move, but it is a clear buy to sell. Very obvious. We know them as fake outs, and you'll have got, as soon as price goes above here, you'll have some breakout traders coming into the trade as well, and they will be buying at this level, which adds more liquidity into a sell position. So the banks love that and can use that to quickly get a fast result and make their millions on a trade. Okay, so move price on. That's not the absolute key bit I want to talk about today, but sorry, actually, we'll just come back a fraction, because something I didn't mention before is it's easy for banks to get into a trade, or relatively easy, because they know where orders are. They are privy to that information. We don't have it as retail traders, but they know where orders are in the market. So if there's a lot of orders in the market, a lot of buy orders at this level, they'll know that, and so they can wait for price to reach that level. They know there's a huge amount of buying going on, they can sell it. It's okay for them to get in. It's relatively easy because they can just wait for price to reach one of these liquidity levels that they need, or they can manipulate it slightly so it push it into those liquidity levels. But what they can't do is easily get out of the position. This is the real key to it, because they're selling at this level. At some time, they've got to get out of that position. If price just comes down and then reverses on them and goes back up, they're stuck. They need to be able to get out of the position. I mean, if price comes down and they can't get out of it because there's no liquidity, they're stuck in that position, and they could end up, as I say, losing money on the trade, which is something the banks don't like doing, and they very rarely do. So they need to know that there's liquidity in areas to better get out. And where would liquidity be? Let's have a look. If you are, we've had a nice little pullback here, starting to buy here, where are you going to put your stops? They're going to be there. You're buying, these are sell orders here to get out of your position if you're wrong. People buying again, where are the stops? Under this level. Buying again, stops under here. So you've got this whole area here. All of this area is liquidity. Banks can take the price down, utilize all of these stop losses that are in this area, which are sell orders, and buy back their position. So they can buy all of those sell orders, get out of their position, and price. So price is reversed. They are totally and utterly closed. So they've come down from here, selling, 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 close their position. Done. They couldn't sell it here. There's no liquidity. Sorry, they couldn't buy back their position here and close the position here. There's no liquidity there. The liquidity is down here. So they need price to come down to here. And it might be that they pushed it down there. They might have added to their sell position at some time, because if you see here, price started to bend up a little bit, and it looks like it's actually running out of steam on the downtrend and might even be curling back up. Banks don't want that to happen, so they might have piled a bit more money into it to push price down into that liquidity area, because that's quite a big couple of candles that's happened there. Okay, so hopefully that makes sense. Getting into the market is one thing. It's not easy to get in for the big banks, but it's not as hard as getting out. And so hopefully that explains a little bit about that. Let's have a look at this position now. You've got a top, a top, a top, and a top. You've got at least a triple top there. That's an area of interest for lots and lots of traders. That's an area of resistance. You know, you believe that is a nice firm stop there. Price isn't going to get above that level unless it just spikes up and just fakes out and comes back down. That proves the fact that this is a strong level. So therefore, that's a good protective area to hide your stops behind. So as price is coming down here, again, stop losses will be up here. They might give it a bit more room this time because of this wick coming up and hitting it, so they might be well above there. So banks are looking at this saying, we know there's a lot of liquidity up here. Let's have a look what happens. Let's just draw in. So up here, there's liquidity. There's lots of buy orders up there. Okay, price is back in the area. Again, some people will be selling from this area, thinking it's reaching, you know, a triple top. There'll be a lot of people selling. So again, they'll be putting their stops up in that liquidity area. What's happened here? What's all this about? That is clearly a bank move. You can't move the market that far that quickly in a couple of candles to by just retail traders. So banks have moved that market up. Why have they moved it up? Why would they be buying at this level? They previously used this level as a selling level. They've deemed that as being a high price to sell from. Why have they changed? It's only a matter of a couple of weeks later. Why have they changed to think that this is now cheap and a buy-in? There's absolutely no reason for them to do that. So when you see this move here, be wary. What's happened? It's pushed through. It's broken these highs that are here. What does that trigger? It triggers a whole lot of buying from breakout traders. So there's lots of buy orders going into the market. There are a lot of stop losses being triggered. So a load more buy orders being triggered. And the banks and large institutions are soaking up all those buy orders, selling to them, building their sell position. And that's what's happening here. You can see there's lots of buying, lots of selling. It's perfect. A lovely move up, a retrace back. Crikey, you know, retail traders are saying this has proved it. It's done a lovely retest of this area, this level, and now it's going up. I'm buying. Banks saying, I'll have that. I'll have all that buying liquidity. And they fill their positions. Now they're filling their positions to around about 2/3 or 3/4 of their whole position, whatever they need to put on during this time. It's taken a little bit of time because it's a big position. Once they've actually done it, they'll dump the rest of it all in one go. The reason why they do that is because that moves the price down. Because there isn't the liquidity to fill it at these levels, so it has to go down, price has to go down to fill their orders. And if they're dumping a load of big orders into there, then the price has to go down quite a long way to be able to fill their order. And that's exactly what happened. So price has moved down. It keeps on moving down. What happens? Banks are in. They're in a big sell position. They've got to get out of it. The easy bit's getting in, relatively easy, because they knew the liquidity was up here. That's fine. Push price up into it. Get all the orders. Build their sell position. Dump the rest of the sell position in here. Take the price down. Where is liquidity to get out of this position? You've got a tiny bit there. There'll be a little bit under there. A little bit under there. And quite a lot under there. And then if it needs to come down any further, there's quite a lot under there. That's probably the most significant low. So there's a lot of liquidity under here, and that's quite a significant pivot low there. These are less so, so there's less liquidity under here. That's for people that are buying and putting their stop loss obviously underneath. Prices come down. Looks like, you know, a little bit of something's happened then. Maybe they've trimmed some of the position off. Come down into a little bit more, trimmed a bit more of the position off, and then come down into this price level where that's quite a big liquidity zone, taken most if not all of their position off at that position at that level, and that's 130 odd pips as a move. If there was still some position left in place, then there it is again. They're into that area to better close the rest of their position off. Okay, that's pretty much what I want to go through today. I don't want to make this video too long. I've already been going for however long it is, 26 minutes, crikey. I'll do a follow-up on this because there's more price action that carries on after this that is very, very useful. But just quickly, we'll zoom forward to price as it is now. So a few months later, we're in December now. We are at this level here. Let me just zoom out. What have we got here? Got a great uptrend. Not broken, no structural break until this point here. Get it about right, that's about the spot there. So we've got this area now. Look at it. This is the area we'd be interested in. Big uplift, big uptrend, a sell-off to break structure. This area here has broken and closed below this significant pivot low. Therefore, structure's broken. This is the area that we're interested in, the price. And look what happens when price comes back up to it. Unbelievable. Where have we seen this before? We've just done it. We saw it in July and August. This. And look what's just happened. What's caused that? Same as what we just saw before, pretty much. And it's done it in one candle this time. So the banks have pushed through into the liquidity which is sat up here. Look at it. I mean, resistance here. This is too good to miss for the banks. All these bounces off, all of these stop losses that are above here, buy orders, and then breakout traders come in as well. Just the same as what happened before in July and August. So I'll be pretty amazed if the banks aren't now accumulating a sell position, and at some time in the next day or so we'll see price tumble to the downside. It might not happen, but that's what it looks like to me, and that's what happened in July and August. And I think hopefully from what I've explained to you, you might be able to follow that and understand that yourself. So you've got lots of opportunity here to get in to this position. Or you can wait. Wait for it to break below this level and get in. Give you some confirmation, just take a few pips out of it. But the brave person and the person that understands market liquidity and how banks trade, generally speaking, will be in now and sell. So I'm going to do a follow-up video to this shortly. Maybe by that time this will have played out and I'll be completely wrong, or I'll be right. Let's have a look later. But hopefully that's been of help to you. Maybe you've had one or two moments where you thought, oh yeah, I understand slightly a bit more now. And again, apologies, I'm not the best explainer of things, but any questions, put it in the comments. If you do want me to do some more videos and explain in detail a bit more about this, then give me thumbs up and likes or whatever you do on these things, and I will endeavour to do a few more videos. So thanks very much.